This is an analysis from Alpha Business Media.
So there's this really interesting disconnect happening in Nepal right now. On one hand, you have the official story from the banking sector, which suggests everything is under control. But on the other, you have the reality on the ground, which tells a very, very different story. Let's dig into what's really going on here.
Okay, so here's the tale of two economies. Officially, the banks are reporting that non-performing loans, that's bad loans essentially, are hovering around a manageable 4%. Now 4%, that sounds pretty good, right? It suggests the system is healthy. But then you step outside, you walk down the street, and the picture is completely different. You see businesses shutting down, construction sites sitting silent, and a feeling that there's just no money moving through the system. The numbers just don't line up with what people are actually experiencing.
Which leads us to the billion-dollar question, doesn't it? If the real economy is struggling this much, how in the world can the bank's balance sheets look so clean? What gives?
And the answer, really, is what this whole analysis is about. The real risk isn't in the bad loans that are being reported. The real risk is hidden. You see, this isn't a story about the bad loans you can see. It's a story about all the ones you can't.
It all comes down to a practice that's become widespread, a kind of financial magic trick, if you will, called evergreening. It's a dangerous game of extend and pretend, and it's hiding the true scale of the problem.
So, how does this actually work? Well, it's deceptively simple. Imagine a borrower can't pay the interest on their loan. Now, instead of declaring that loan as bad, which would hurt the bank's profits, the bank just gives them a new loan. The borrower then takes that new cash and uses it to pay the interest on the old loan. See the trick? On paper, the loan looks healthy. But in reality, the can just got kicked down the road and the problem actually got bigger.
Let's make this real. Picture a large hotel. They have a 1 billion rupee loan, but tourism is down and they can't make their payments. Now, if the bank admits the loan is in trouble, they have to take a 250 million rupee hit to their profits right away. Ouch. To avoid that, they play the evergreening game. They issue a new, smaller working capital loan of, say, 100 million rupees. That money flows right back to the bank to cover the interest on the big loan. And here's the kicker, the bank is now more exposed to this failing hotel, not less. Their total risk just went up to 1.1 billion rupees.
So why on earth would banks do this? I mean, it seems so risky, right? Well, it's all about incentives. The whole system is kind of set up to encourage it. First, there's a regulatory loophole that lets them get away with it. Second, bank managers want to protect their profits to get their bonuses. And third, you've got shareholders who expect their dividends. Those dividends, by the way, aren't coming from real profits. They're coming from this financial shuffling just to keep up appearances.
So you might be wondering, how does this story end? Well, we don't have to guess. We just need to look next door to what happened in India back in 2015. It's like a dress rehearsal for what's coming to Nepal.
You see, before 2015, India's banking sector looked a lot like Nepal's does now. Artificially low bad loan numbers, with everyone playing extend and pretend. And then, the central bank basically said, enough is enough. They launched this thing called an Asset Quality Review, or AQR. Think of it like a system-wide financial audit on steroids. They sent teams in to look past the paperwork and judge loans based on the real health of the business. It was painful for sure, but it was the only way to clean out the rot.
And look what happened. Just look at the shock to the system. The moment they turned on the lights and forced everyone to tell the truth, boom. The official bad loan ratio nearly doubled. All those hidden losses that had been swept under the rug for years suddenly came rushing out into the open. Bank profits evaporated, and the market was completely rocked.
Okay, so let's bring this all back to Nepal. That gap we talked about between the official story and the reality on the ground, it's getting wider and wider. The pressure is building on the central bank to do something. A day of reckoning, just like India's, isn't just a possibility anymore. It's an inevitability.
So here is the key takeaway for anyone invested in or doing business in Nepal. It is no longer a matter of if an AQR will happen, it is only a matter of when. And when that day comes, believe me, it is going to set off a powerful chain reaction.
First up, the NPL shock. That official 4% number, forget it. We're talking about it jumping to a real number, probably 8, 9, maybe even 10% or more, almost overnight.
Next, what happens when bad loans are finally called bad loans? Bank profits get crushed. They'll be forced to set aside huge amounts of money to cover these newfound losses, and that will just vaporize their profits. This will happen even for some of the banks we think of today as the strongest. And of course, if there are no profits, what else disappears? Dividends.
Yep, many banks are going to have to cut their dividend payouts right down to zero, likely for several years as they try to rebuild their capital.
And the final domino to fall? Mergers. Lots of them. The weaker banks, the ones with the biggest hidden problems, simply won't be able to stand on their own. They'll be forced into shotgun weddings with stronger players. The entire banking landscape is going to get redrawn.
Okay, so that sounds pretty intense, I know. A storm is definitely on the horizon. The big question then is, how do you navigate it? As an investor, how do you prepare for this kind of fundamental shift?
You have to throw out the old playbook. Seriously, the old game was just about chasing the highest reported profit or the biggest dividend. That's a rearview mirror approach, and worse, it's looking at numbers that might not even be real. The new game is about one thing: survival. It's about finding the banks that are built to last, the ones with the cleanest loan books, the strongest capital, the ones that are managed conservatively and are already prepared for reality.
Look, there's no doubt this process is going to be painful, but it's a necessary pain. It's the kind of cleansing the system needs. It'll finally separate the well-run banks from the reckless ones. Because at the end of the day, you can't build a strong economy on a foundation of make-believe. The pain brings reality, and it's only from reality that you can begin to build real, sustainable growth.